So there's been finally this repricing that's still underway. When you take a look at expectations for a pivot, for a pause or a cut, has that meaningfully changed too?
Yeah, I think it certainly has. The focus is when the Fed is going to, stop its hiking cycle, when it reaches terminal. But really, the market has been most aggressive around rate cuts. At one point, the market expected the Fed to cut, upwards of 200 basis points about a year after it reached that terminal value. That's come in a lot. So kind of this higher for longer message is certainly making its way into the market. And I would say that a lot of the risk rally that we've seen at the end of last year going into the beginning of this year was based on the view that the Fed was going to cut aggressively. And with that kind of being repriced and being pulled in, you see risk assets, really trying to find their way in an environment where data is still somewhat volatile around that concept.
What's also volatile is expectations as to how the China reopening plays out, right? Are you looking for different ways to get exposure to that? What are the opportunities that you're seeing at the moment, given there's so much repricing and uncertainty?
Yeah, I mean, it's still in its early stages. Certainly, we have a team in Hong Kong that follows it closely, and the lack of data recently has made it a challenge to really stay on top of what's going on. A lot of their work around alt data, kind of looking at mobility through other sources, shows that it's continuing to move along. And I think with the NPC coming up, as well as maybe some of the data becoming a little bit more frequent, we do think that there's still room for that trade to run, but would probably focus on it within China before really seeing it move into other parts of the region. It's going to start in China, and that's probably where it's easier to focus on right now.
To your point, Marvin, we have seen this chart on the Bloomberg showing how a rising dollar has pummeled those Asian stocks, right? When it comes to the broader emerging markets complex, when you are still focused on China, and given the weighting of China in broader EMs, is it eventually a positive trade?
You know what? It is as we kind of move through this reopening process. A stronger dollar and really a repricing of the Fed, however, is just this massive hammer that's going to keep EM on its back foot. That doesn't mean that you don't want to go into the EM complex completely, but you do have to be selective in an environment where the Fed, the dollar, and higher U.S. rates can really reprice everything, on any given week, given how volatile things are.
When you say selective, would you venture into those markets that have aggressively hiked even before the Fed?
Yeah, I think higher real yields are going to be an important part of the story. I think understanding commodities, but not necessarily just broadly commodities, but looking at the actual things that are coming out of the ground and whether or not you can make a case that demand for that kind of continues, even if you're in an environment of economic uncertainty. That's how you really have to approach it.